All right, let's dive in. Today, we're going to plug into a company that's right at the heart of the huge global energy transition, a business that's literally rewiring our grids to be smarter, stronger, and way more efficient. Let's get to it. But first, let me ask you something. Put yourself in the shoes of a big utility company. Demand for electricity is just exploding, right? You've got EVs, data centers, plus you have to connect all these massive new wind and solar farms. But here's the catch. You can't just build new transmission towers everywhere. It's incredibly slow, it's wildly expensive, and let's be honest, nobody wants one in their backyard. So what do? How do you cram more power down the existing wires?
Well, the answer isn't just throwing more metal at the problem. It's about smarter engineering. And that's where our company for today comes in. A business that has built its entire identity around solving this exact puzzle. Apar Industries.
So to really get what makes Apar tick, you've got to understand the huge problem they're solving. We are right in the middle of a massive global grid upgrade. I mean, every single megawatt of new renewable power needs a highway to get to our homes and factories. And that's creating a structural demand story that's going to play out for decades.
But here's the complication, the big bottleneck. Building brand new transmission lines is an absolute nightmare. We're talking permits, land acquisition, getting the right-of-way, and endless public opposition. It can take a decade, maybe more. But upgrading the lines you already have, that's faster, it's cheaper, and it has way fewer headaches. And that right there is the critical pivot point for the entire industry. Now, I know what some of you might be thinking. A company that makes conductors? Wires? Sounds kind of boring, right? Well, stick with me, because we're about to debunk that idea and show you why that's a huge mistake. This industry is so much more complex than it looks on the surface.
I absolutely love this quote from our source material because it just cuts right through the noise. Thinking of this business as just selling metal wires, well, that's just lazy analysis. If it were that simple, believe me, the economics would look totally different.
So here's the myth, that this is a low-margin, commoditized slog of a business. But the reality for Apar? It's a story of premium margins, an engineering-first mindset, and a return on capital employed, that's ROCE, that is consistently smashed through the 20% mark. You just don't get numbers like that by selling plain old metal wires.
And this chart shows you exactly why that myth is just wrong. See, Apar isn't just a conductor company. It's a really smart, diversified industrial player. Yeah, conductors are the core engine, but they also have this highly profitable specialty oils division. Think of the crucial oils that cool transformers. That gives them stability and a high-end cables business for very specific, demanding uses. This mix is absolutely key.
Now for the real star of the show. HTLS. That stands for high-temperature, low-sag conductors. And listen, these are not your grandfather's aluminum wires. These are sophisticated, engineered composites. They can carry way more power and handle much higher heat without sagging dangerously. They are the secret sauce, the elegant engineering fix for that massive grid bottleneck we talked about at the start.
And that engineering is what creates Apar's powerful competitive advantage, its moat. We're not talking about a brand name here. We're talking about a deep, technical moat built on qualifications. It's why a big utility in the US or Europe can't just wake up one day and switch to a cheaper supplier. And a little later, we're going to get into the kill switch scenarios that could actually threaten this whole setup.
So how does that moat actually work in the real world? This timeline spells it out beautifully. Before a company like Apar can even think about selling its high-voltage wires to a major utility, they have to go through this grueling 12 to 24-month qualification process. It's a gauntlet. Their products get tested for everything imaginable: reliability, performance in extreme weather, you name it. Once you're in, you're in. The cost and risk of switching for the utility is just too high.
So let's just break that moat down into its 4 key pillars. 1, superior product engineering, like those HTLS conductors. 2, that super high qualification barrier we just talked about. 3, actual approvals from major utilities all over the world. And 4, a really clever business model that shields them from the crazy swings in metal prices through pass-through contracts. Basically, if aluminum prices go up, that cost gets passed straight to the customer. Smart. Okay, the story sounds fantastic. The engineering is smart, the moat seems real, but you know what? Stories don't pay the bills. Now it's time to put the financials under the microscope and see if the numbers actually back up the narrative. This is where the rubber meets the road.
First up, the big one. A sustained return on capital employed consistently above 20%. Let that sink in. For a capital-intensive company that actually makes stuff, an industrial company, that is just an exceptional number. It tells you management is incredibly good at putting money to work and earning great returns on it.
All right, next, let's do a little truth test. In this industry, it's super easy to show big profits on paper while you're actually bleeding cash. It's called the working capital trap. But look at this. Apar's cash flow from operations, or CFO, has pretty much hugged its EBITDA for the last 3 years. That proves the earnings are real. The cash is really coming in the door.
And this table just fills in the rest of the picture. Their PE ratio, right in line with the industry, nothing crazy. Return on equity has been fantastic, averaging well over 20%, which totally backs up that high ROCE we saw. The growth numbers are impressive. Look at those 3-year compound annual growth rates for sales and especially for profit. You can also see their profit margins have been expanding nicely. And crucially, their debt-to-equity ratio is very comfortable. They aren't juicing their growth with a mountain of debt. To top it off, the founding family, the promoters, still own over half the company, so their interests are aligned with shareholders. Bottom line, the books are clean, really clean.
Okay, it can't all be sunshine and rainbows, right? Every investment has a dark side. So now we have to ask the really tough question. What could kill this whole story? What are the kill switch scenarios that could actually make you lose money here?
So, kill switch number 1. This is the big external boogeyman, a full-blown China price war. If huge, state-backed Chinese manufacturers decide to just dump product on the global market to grab market share, they could absolutely crush margins for everyone, even on premium stuff like HTLS. This is the number 1 structural risk you have to watch. Kill switch number 2 is a self-inflicted wound. It's a classic industrial trap, getting too aggressive with expansion at the very peak of the demand cycle. Imagine management gets over-optimistic, they see booming demand, and they go on a factory-building spree right before a global slowdown hits. That can destroy shareholder returns for years to come. Discipline here is everything.
And this matrix just lays it all out for us, really. You can see the China price war has a moderate probability, but a potentially extreme impact. Same goes for the risk of the company getting desperate and underbidding on big projects just to win them. Other risks, like utilities suddenly freezing their spending, are also on the radar. So what's the big takeaway here? The real company killers, the highest impact risks, are all about fierce competition and management staying disciplined with their cash. All right, we've looked at the good, the bad, and the potentially ugly. We've seen the opportunity, the moat, the financials, and the risks. So let's bring it all home. What is the final verdict on Apar Industries? When you strip everything else away, the investment case really boils down to 4 simple steps. 1. You have this massive long-term structural demand from grid modernization around the world. 2. Apar's HTLS technology gives them a legitimate engineering advantage. 3. That tough utility qualification process creates a real, durable barrier to entry. And 4. The pristine financials prove this isn't just a nice story, it's a disciplined, cash-generating machine.
So here it is, the final call. Apar Industries looks like a high-quality, execution-dependent industrial compounder. Now, what does that mean? It means this isn't a buy-it-and-forget-about-it defensive stock. Its success hinges on management continuing to execute flawlessly. But for an investor who wants a smart way to play the global infrastructure build-out, this looks like a very high-quality place to be. And that leaves us with one final, big-picture question. In a market that's so often obsessed with flashy tech, with hype, with the next big thing, is it possible that this kind of boring, disciplined, world-class industrial execution is the most powerful and maybe the most underrated competitive advantage of all? Something to chew on. Thanks for tuning in.